All right, let's jump right in. We're going to connect some pretty big dots today. On one hand, you've got this major signal from the Federal Reserve. A rate cut is probably coming. And on the other hand, you've got a super popular and kind of controversial stock, Palantir. So how do these two things connect? That's what we're here to figure out.
This is really the question, isn't it? The Fed finally cuts rates. So, is that the starting gun? Is it time to pile into those high-growth stocks you've been watching? Or is it actually a red flag, a sign that maybe the economy is a little shaky? Let's unpack that.
So here's how we're going to tackle this. First, we'll look at what history says about rate cuts. Then, we'll dive into all the big news swirling around Palantir. After that, we'll get into why the analysts just can't agree on it, and I'll lay out a potential playbook for you. And finally, we'll tie it all together. Simple enough, right?
All right, section 1. Let's talk about that rate cut. You know, to figure out where the market might be going, it really helps to look back. What's happened before when the Fed has done this exact same thing? Okay, this is super interesting. So trader Mark Minervini did the homework. He looked at the last 13 rate cuts. And in the short term, like the first 30 days, it's basically a coin flip. The market went up 6 times and it went down 7 times. You just don't know. But get this, if you just wait a little longer, just 3 months, the picture completely changes. The market was up 12 out of 13 times. 12! That's a seriously bullish signal.
And we're not talking about small gains either. On average, the S&P 500 jumped more than 5% in those 3 months following a rate cut, assuming we weren't already in a recession. So what that tells us, historically anyway, is that even if things are a little shaky at first, that initial volatility tends to fade pretty quickly and turn into a really solid rally.
Okay, so that's the big picture market vibe. Now, let's get specific and zoom right in on our case study for today, Palantir. And believe me, this is a company that's been making some serious waves all on its own. And I mean, what a week they've had. First, they're on the verge of landing this massive, nearly $1 billion deal with the UK military. Then you've got a Mizuho analyst just raving about their astonishing execution and bumping up the price target. On top of that, they snagged this really important cybersecurity certification, which basically paves the way for more US defense contracts. Of course, the market absolutely ate it up, and the stock shot up.
So with all that amazing news, you'd think every single analyst on Wall Street would be screaming, buy, 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 right? Well, not exactly. And this is where things get really interesting and, frankly, a bit confusing for anyone trying to figure out what to do. Yeah, take a look at this. The experts are totally divided. Out of 20 analysts, a big majority, 13 of them, are basically saying pump the brakes. They're rating it a hold or even a sell. Only 7 are bullish. So what gives? With all this incredible momentum, why are so many of them so cautious?
Well, the answer really boils down to one little number, the PE ratio, or price to earnings. All this really means is how much are people willing to pay for the stock for every dollar of profit the company actually makes. Now, a high PE isn't always a bad thing. It just means that investors are expecting some seriously huge growth down the line.
So, what's Palantir's PE ratio? You might want to brace yourself. It's 276. Let me put that in perspective for you. The average PE for a company in the S&P 500 is somewhere around 25. So yeah, 276 is sky high. And that is the heart of the problem for these cautious analysts. They see all the good news, for sure, but they also see a stock price that seems to have already priced in, like, years and years of absolute perfection.
Okay, so what are you supposed to do with all this? On one side, you have amazing news. On the other, you have this crazy high price tag. It's a classic dilemma. And that brings us to the playbook. Let's try to build a strategy here by breaking it down based on how long you're planning to invest. So we're going to look at this in 3 chunks, right? What to think about right now, in the short term. What the plan could be for the medium term, say the next year or so. And then how to position yourself for the long haul. It's a simple way to clear out some of the clutter. All right, let's really dig into the strategy. For the short term, the thinking is maybe just hold or even think about selling a little bit. Why? Well, the stock just went on a tear, and it's pretty common for people to cash in and take some profits off the table. But then you look out to the midterm, and things start looking a lot better. The demand for AI isn't going anywhere, and that huge UK deal should start hitting the books. That's when you might consider buying. Now, for the long term, the idea is to buy on the dips. The company's long-term story looks really strong. But with that high price tag, it's just a whole lot safer to buy when the stock has a bad day or a bad week, instead of chasing it when it's already flying high.
Okay, now for the grand finale.
This is where we bring it all home. Let's connect these two big ideas, that macro market outlook we started with and this very specific strategy for Palantir. This is where it all comes together.
You know, there's a great analogy for this. Think of the overall market, all that stuff about Fed rate cuts, as the weather. Some days it's sunny and calm, other days it's stormy and unpredictable. But the actual company you invest in this case Palantir, that's your ship. A really well-built ship can get through some nasty weather, but a leaky ship? That could sink even on a calm day. You really have to understand both the weather and the ship.
And check this out. This is how perfectly it all lines up. That short-term hold or sell advice, it makes total sense when you remember Minervini's data about the market being a coin flip right after a rate cut. It's just too unpredictable. Then that midterm buy recommendation, that lines up with the historically strong market we see 3 months out, which is just enough time for Palantir's big contracts to start making an impact. And finally, the long-term buy on dips play, that fits perfectly in a market that's generally trending up after rate cuts. It lets you be patient and build a position in a fantastic but pricey company without overpaying.
So I'll leave you with this to think about for your own strategy. When you're making a decision, what are you paying more attention to? The day-to-day market weather or the long-term strength of your ship and its ability to sail through whatever comes its way? It's something we all have to ask ourselves. Thanks for tuning in.